Hi guys, so this is a quick trade review on how you'd have engaged after FOMC yesterday. And whenever you're watching this, it's still valid anytime. So we had this bullish fair value gap that price has really stayed here for a very long time now and really did not do much. But it used it here to reach an all-time high, came back right here, took out sell side liquidity here. So after the sell side liquidity, we had this bullish candlesticks here. So this is a bullish order block here, right here. But this is not really a concern right now. So I'll show you how you would have engaged, how I also engaged, and probably you too would have also engaged with FOMC after FOMC yesterday. So let's go to the 4 hours. Okay, let's go to the 1 hour time frame. So it traded off this daily fair value gap here. After that, it gave us this bullish order block, and we also had a fair value gap that it traded in during the London session, creating this order block here. So after that, we waited for it to trade right back to the order block, but we had this fair value gap that it didn't respect. So our order block was our last line of defense. I also wanted to see it trade deeper to this fair value gap, but it didn't. So let's see. We have buy side liquidity here from the daily time frame resting here. This is a buy side liquidity resting here. This section. So let's see the 30 minutes. So in the 30 minutes, we've seen how we trade here. This way the order block from the 1 hour is consecutive down candlesticks. Then 15 minutes, we had this. Now this sharp move here. This was the NF, not the FOMC, I mean FOMC. So after the FOMC created this gap here for us, this is a bullish fair value gap. Just after reacting of the 1 hour order block. Yeah. So let's see how entry will be like from the 1 minute time frame. So we are looking at engaging after the FOMC. Okay. So you know our target will be the buy side liquidity resting above there. But if you have a good risk to reward before that, you can exit. Okay. So this was the FOMC move right here by 2 o'clock New York time. Yeah, this is a quick move, and this is a 15-minute fair value gap here. So this I would have engaged from here. After the sell side was taken, the sell side here created by 218 to 19 to 20. After the sell side was taken here, we had this move higher, disrespecting this fair value gap, bearish fair value gap, which has become our inversion fair value gap now because we are bullish. So every opposing fair value gap becomes an inversion for us. Took out this high here. So once it took out that high, you see how it retraced back to the inversion fair value gap. That's so perfect. So now this is how our entry will be. Our entry will be right at this inversion fair value gap. And also at this inversion fair value gap, we have a bullish fair value gap that failed here to enter after it took out this high. I'm not really interested in it trading here. If I even take a trade there, that will be a low risk entry. I'll risk a little there, but this is really the trade I'll be confident in taking because it has taken out this high and I'm bullish. Okay, so my stop loss now will be here, just right at this low, the low of that fair value gap there. Probably keep some space just in case it wants to come a little bit lower. So be merciful with your stop loss. So how would my targets be? So for my target, I'll use the standard deviation of the Fibonacci tool. So this will be our standard deviation here. Right at this swing here that took out this sell side liquidity here, we'll measure, take it high from here. So I take profit can be right at the minus 0.5 standard deviation or the minus 1 or the minus 1.5 standard deviation. That would be a good take profit, depending on how long you can stay in the market and how long you're willing to be in it. So standard deviation minus 0.5. So the reason I'm using standard deviation because if you check to your left, you won't really see any clear buy side liquidity here. So we can use as our target. So because we are not having that, we use our standard deviation for that to get our target. So your target can also be here, the minus 1 or minus 1.5. So let's see how we behave at minus 1.5 standard deviation. So getting to this 4:20 New York time, the market would have started closing, preparing to close. So I think this would have been a good trade already. So we closed from there because the market is almost clean. But the target was already reached by 6:30 New York time. So that would have been a beautiful trade. All right, guys. So that's how I would have engaged, and that's how I engage, and that's how I will engage next FOMC. So you can take advantage of that and go to your chat practice and get used to seeing this on the chat. Okay. So that's it.